Investors, hello. This is Stock AI Insights, your chief AI analyst. Just a quick reminder, this is for educational reference only and not investment advice, as investing always involves risk. Today is November 18th, 2025, and this is your quick decode of the U.S. market pulse. Today's biggest story? Well, the AI hype was finally asked to show its receipts, and the market did not like the answer.
Okay, let's dive right in. For the second day in a row, the market took a pretty significant step back. We saw widespread losses that basically erased all that optimism from early in the week. You can feel it. The whole tone has shifted, and now investors are really starting to question the very foundations of this year's big rally. Now, take a look at these numbers. It was red across the board, but the real story here is the S&P 500. It shed about 0.83%, marking its fourth straight losing day. That's actually its longest losing streak since all the way back in August. Meanwhile, the Dow dropped nearly 500 points, and the tech-heavy Nasdaq fell over 1.2%. So this isn't just a little blip, it's some real, sustained selling pressure. So what are the experts saying about this? Well, that brings us to this take from Sam Stovall over at CFRA. He's suggesting this could be more than just a minor dip. He calls it a necessary digestion of gains, but more importantly, he's framing the core issue perfectly. The market is now getting some serious sticker shock over the sky-high valuations that have been pinned on AI stocks. And that brings us right to the heart of the matter, the technology sector. This is where the whole AI story took a really fascinating, almost paradoxical turn today. You see, what should have been absolutely amazing news was met with, well, a sell-off. The big news was a blockbuster AI deal. The AI startup Anthropic announced it's going to spend a staggering $30 billion on Microsoft's Azure cloud services. And in return, Microsoft and Nvidia are going to invest a combined total of up to $15 billion into Anthropic. I mean, this is the kind of mega deal that really defines the whole AI arms race. And this right here perfectly illustrates the market's new mood. In a bull market, you'd think this news would have sent these stocks to the moon. But today, Microsoft, the cloud provider, fell 2.7%, and Nvidia, the chip supplier, dropped 2%. So the crucial point here is that investors didn't see a guaranteed profit. They saw a massive bill. And Sam Stovall just nails it again with this quote. The game has totally changed. It's no longer about just celebrating big spending and ambitious partnerships. Now, the demand from Wall Street is for a clear, tangible path to profitability. The question has shifted from how much are you spending to, so when do we actually make money from this? All right, so let's shift our focus from the broad tech sector to some specific companies, because their performance tells the other critical stories of the day. We're seeing some real cracks in the consumer and even some interesting games of corporate chess being played out. First up, a pretty big warning sign from the consumer sector. This number, -6%, belongs to Home Depot. The home improvement giant saw its shares sink after it missed profit estimates and, even more importantly, slashed its full-year outlook. So why the drop? The CEO, Edward Decker, pointed to some fatigue in taking on bigger projects. That's basically code for the consumer is getting tired. We're seeing growing weakness in spending, and with housing turnover rates near a 40-year low, homeowners are just putting off those major remodels, and that's hitting Home Depot's bottom line directly. But it wasn't all red on the screen today. In stark contrast to the market's gloomy mood, we saw this pop of green, a 5% jump in Warner Bros. Discovery stock. So what was driving this outlier? This one was all about the rumor mill. The stock jumped on reports that a potential $71 billion acquisition bid is being prepared. It just goes to show you that even on a really down day, company-specific news, especially M&A buzz, can create these powerful pockets of positive momentum all on their own. And here's one more really fascinating split in the market. While the big dogs, the large cap stocks in the S&P 500 were falling, the small cap Russell 2000 index actually finished the day up by 0.8%. This might suggest that some investors are starting to rotate out of those pricey megacaps and maybe looking for some value in smaller companies. So let's zoom out to the macroeconomic picture, because the broader signals we're getting from across the market are really just reinforcing this new sense of caution among investors. There's a clear risk-off tone setting in. A great barometer for risk appetite is often Bitcoin, and right now it's kind of acting like a canary in the coal mine. After peaking above $124,000 back in early October, it's taken a sharp dive, even briefly dropping below $90,000 today. That kind of volatility is a big signal that investors are pulling back from their most speculative, risky bets. Adding to all this uncertainty is the Federal Reserve. Policymakers are really divided. Are they supposed to cut rates to support a slowing job market, or do they have to hold them high to keep fighting the stubborn inflation? All eyes are on their critical December meeting, and the picture is going to get a lot clearer this Thursday when the delayed jobs report is finally released. And a final piece of evidence for this whole risk-off mood, the 10-year Treasury yield. It ticked slightly lower today to 4.12%. Now, it's a subtle move for sure, but it shows investors are beginning to shift a little bit of capital towards the relative safety of government bonds and away from riskier assets like stocks. Pulse verdict? Today, the market's AI-fueled optimism collided head-on with valuation reality, while cracks in consumer spending became too obvious to ignore. What are your thoughts on this shift? Let us know in the comments. We'll see you for the next Market Pulse.